Today, we're going to debunk the 5 biggest myths about quant trading and what actually works here on the Independent Quants podcast, episode 9, with your host and the founder of the Independent Quant, Luis. Welcome, everyone, to the Independent Quant. Thank you for joining us. Remember, this podcast are for educational purposes only. I'm not a financial advisor, nor am I giving you advice as to what securities to trade, not making any guarantees of success or profitability. But with that out of the way, let's jump right in. What are the 5 biggest myths in quant trading? You know, quant trading is supposed to be so complex, so difficult to do. That's true at a very high level. But myth number 1, you need a PhD in mathematics or some other advanced STEM degree in order to be a quantitative trader. Now, that's not true. Now, those are the folks that definitely have broken a lot of ground in quantitative trading. There are the folks that make it into the large hedge funds and large firms that are developing and pioneering new quantitative methods on how to make money out of them, extract money out of the markets. But is that necessary, right? No, it's not. You know, at a very high level, maybe if you're trading trillions of dollars, and if you are, thank you for listening to me. But that usually you're not the person I'm talking to when I'm making these podcasts. You know, it's there's a place for those types of credentials, but no, the reality is you don't need advanced math and programming skills to be a quantitative trader. You do need to have proficiency in probability and statistics. You can't be a newbie. Say you need some level of facility as to what probabilities are, where they come from, different statistics, and maybe some loose modeling in there and what statistical models are and how they work and how to troubleshoot them. Because nowadays, a lot of these things are handled programmatically using libraries. So you just need to know what's happening or be empathetic enough to the technology to be able to know how to troubleshoot. But you don't have to build it from scratch, which is what a lot of those large firms are doing with these very intelligent people that have achieved great things academically. For us, we're not inventing the wheel. We just need to have a clear enough understanding that we can implement our strategies. With that, you need, so I said probability and statistics. With that, you need to have some level of facility with a programming language. The most popular right now is Python by far, much to my dismay. When I started doing machine learning, in 2016, my programming language of choice was R. It made perfect sense to me that R would be the language that we would all use because it is statistical software and we were doing statistics. And Python was a general programming language. There should be no reason for us to be using that. I was wrong. I lost. R is still very much a viable programming language that you can use. There's an R in Finance conference that happens in May up in Chicago. I've attended that. That's pretty awesome. If you're ever looking for a way into discovering how quantitative traders that are not PhDs are engaged in all this. Now, some of these people do have advanced degrees, not PhDs, but they've at least majored in this stuff. But yeah, you can go and learn more about these programming languages. There's entire communities for them, for Python and R. You can even go so far as to use Excel. Now, I'm a pretty advanced Excel user. I would never think of trading the markets with Excel. I can do a lot of analysis with Excel. I do that, but I wouldn't code an entire strategy in Excel. That said, that's me, right? I'm recording this in May of 2025. I think it was a year or two ago, or not Excel, but Microsoft actually integrated Python into Excel. So you can now code Python code in Excel. So nothing really keeps you from being able to take that one step further and use Excel for the markets, because people were doing it even before Python was integrated into Excel. Because of that, all this growth that's happening in those 3 languages that I just mentioned, or the 2 languages I just mentioned, specifically Python, there's been a lot of open source libraries. Python is a free language as it is, as so is R, but Python is a free language and it's become the de facto data science language. A lot of the machine learning libraries that are being developed in Python. The large language models that have pretty much changed the world through ChatGPT and every other type of generative AI that's out there, almost all of that's developed in Python, and all of that's open source. And all of that has documentation out there and an entire ecosystem for you to be able to learn how to use those languages. You don't need a computer science degree. The funny thing is, a lot of programmers, they learn programming before ever going to go get a computer science degree. Now, I started coding in the early 90s in BASIC. Then in high school, I was in AP Pascal, both languages that are dead. But point being was we were coding and doing simple programs well before a computer science degree. I mean, that I would argue that a computer science degree probably doesn't set you up well for this because you're thinking of the computer, not so much of software engineering. They're two different fields. They're huge overlap. But the point being with all that is there is a pragmatic and practical sense on how to approach the markets to just use the tools that are available to achieve your goals. And you don't need an advanced degree to do that. So with that, move on to myth number 2. Quantitative trading always beats discretionary trading. Now here at the Independent Quant, I do bash quite a bit on discretionary trading as our nemesis, but I do remain to want to be transparent with everyone, and every one of these podcasts that I do and every bit of education that we put out at the Independent Quant and anything that goes into our newsletter, it just has to be true, right? I don't want to mislead. And that would be misleading if I said that quantitative trading always beats discretionary trading. That's unfortunately unfortunately or fortunately, depending on how you look at it, just not true. There are discretionary traders out there that are absolutely exceptional at what they do. Discretionary trading has the benefit that a discretionary trader can adjust to market conditions as they're happening. It can maintain awareness of everything outside of whatever strategy that is that they're using to inform their trading decisions. Unfortunately, an algorithm can't do that. An algorithm is limited by whatever logic was coded into it, so it can't flex to current market conditions. Take in alternative data sources if that wasn't already something that was coded into it, so it can't make decisions that it hasn't been told to make decisions on, which is very much what a discretionary trader can do on the fly and read the charts and read the markets and make decisions accordingly. We beat up on it here because it's a very difficult task to do. You have to be insanely disciplined in order to be a successful discretionary trader. But that said, if you are that, then you are that. And you can do better discretionary trading than you can quantitative trading. You just have to look at what your strengths are. But blanket saying that quantitative trading is always better than discretionary trading, no, not the case. So myth number 3, more data equals better strategies. Several years ago, I think it was in the mid 2010s, Google put out a paper on how more data yielded better results. This was like the advent of big data and the big deal of being able to do machine learning with all this stuff. Yeah, with more data comes better predictions, but that doesn't mean better strategies. Because even back then, when we were using big data, we weren't using the entire data set. It just meant that you had more that you could sample from to get a better sample size or a better sample in general. So to think that you just need more and more data, that's not the case. What you need is better data, quality data that is applicable to the strategy that you're coding, and nothing really more, right? It doesn't matter what the data is. What matters is how you're using it. Are you using good sound strategies or good sound models? For your trend following strategy? Are you doing a good model for your mean reversion strategy, right? Is the logic sound that you're going through using that specific data? Are you overfitting your data? Are you adding too many parameters to your algorithm? That matters significantly more than the amount of data that you have. So no, don't go out there and just get more data for the sake of getting more data. Now, the 4th myth here is quant strategies can run on autopilot forever. Unfortunately not. Because of market changes, because of just even computer malfunctions, they can't run forever, right? They must be supervised. Under all circumstances, they must be supervised. Story on this for me, if I've heard my story before, as far as when I started my algorithmic trading, I went live trading in 2019, at the beginning of 2019. By mid-year, I was already coding my own strategies. Well, by the end of the year, I was leasing out strategies and paying for these strategies from wherever I was getting them at the time. And I had one strategy running on TradeStation. This is not a disparaging comment on TradeStation, and this podcast isn't sponsored by TradeStation, so this is just me telling a story here, not advocating for the use of any brokerage. But I was trading a TradeStation strategy, and what I believe happened was, I set it to run. My computer was not to fall asleep. Well, in any case, I leave my home. I come back much later in the day. This is after the market had closed. I was trading futures, so the market had closed and reopened. So it was after 6 o'clock. I remember that much. I open up my computer, and I find that I'm 10% down on my account because this algorithm had not closed a trade. I suspect that happened because when I opened up the computer, I woke it up, and the algorithm just turned off. I guess when the computer went to sleep, the algorithm turned off. So the logic was no longer working. So I had to intervene, close it all out. That was the straw that broke the camel's back on me as far as how I was implementing algorithmic strategies up to that point. But that's just one example of how you can't leave an algorithm running on autopilot forever. You do have to go check on it. In the short run, you have to check on, is it working the way it's supposed to be working? What are its metrics? You did backtests on this thing. Is it performing as well as you deemed it to be? Because that's the reason you took it live, right? Maybe the market's changed. It's a trend following strategy, and the trend in your market's gone. So you can't just let it sit there, because if it could chop you up, and just if you don't have the proper risk management in place, it can continue to trade and trade when it should not be trading, because it's not the ideal conditions for it. Myth number 4 debunked. Do not let your algorithms run on autopilot forever. And the last one here, myth number 5. The more complex the model, the better. Nothing's further from the truth. So usually the simpler the model, the better. There's an entire school of thought out there about black boxes and using these really complex models that are not interpretable to trade the markets, and all that matters is that you're able to generate alpha, generate profit, generate returns. That's fine, and there's been several hedge funds that have approached it that way, some funds that have done that. I don't advocate that. We don't know the success of many of those. Many of them failed, many of them did well. But the point that the more complex the model, the better, just doesn't hold water. It doesn't guarantee success. It can be successful, but it just doesn't guarantee it. You have to be able to assess what the risk is in order to use that model. And typically when you have a simpler model, you can understand where it may be going wrong, what needs to be tweaked, how you can optimize it, how you can adapt it. If it's really complex, you get what you get, and you just have to let it be. And that's it. There's this argument to be made about having an algorithm be explainable. If you can explain what it is that your algorithm does and why it doesn't, you can also probably explain when it doesn't work. Kind of ties back into that whole simplicity of it all. You should aim for something that is simple and robust and adaptable rather than just really complex, especially if you're one person deep running an algorithmic trade desk. When you have, I'm a project manager by trade, right? So it is, I've always said, it's like you take a system and you only use simple processes. Well, as the simple processes stock up and you have more simple processes and more simple processes, eventually you'll have a complex system. You can have a complex system by way of a collection of simple processes. If you take one of those simple processes and you make them complex, your system now becomes impossible to manage, right? It is now, you spend a lot of time managing the complexity rather than managing the deliverables and the actual process itself or the system itself. So there's something to be said to that. Now, those are the 5 myths that really keep people from jumping into quant trading. So what is it that you actually need to succeed? And that's, just being disciplined and systematic, leveraging data wisely, adapt to market changes, and make sure you're keeping complexity under control. If you found all that valuable, then please head on over to the Independent Quant and sign up for our newsletter. try to put this out on a weekly basis. We do podcasts, 2 podcasts a week, along with a market review at the end of the week. And I share where I stand, developing and creating my algorithmic trade desk. If that's value to you, I look forward to seeing you there. Keep coding, keep researching, keep learning, and keep it green. This is Luis, out.